Welcome. I'm Jay Taylor. I'm the editor of Jay Taylor's Gold, Energy, and Tech Stocks. I want to welcome you to the June 18th Metals Investor Forum, the virtual Metals Investor Forum. We're looking forward to the day when we can get back to the real thing, but this is the best we can do for now, and I'm really pleased to be a part of this. I'll be talking to you to provide you with my market views over the next 20 minutes or so, and then after that, the companies that I've invited to the conference: New Energy Gold, Osino Resources, Palangio Explorations, Hannon Metals, and Novo Resources will each provide their presentation, and after that, we will have a question and answer period. I've titled my talk today, Much Worse Than You Can Imagine, Part 2. Part 1 was about a month ago when we were very, very much worried and concerned about the pandemic that was spreading and leading to what may very well become a global depression. But since then, of course, we've had the uprisings, the insurrection, if you will, those that would like to overthrow the United States government as it now exists. We're seeing that vocalized, and I think that is not a small matter. I think you should be very concerned about the impact of the changes that are about to take place in America. I think they can be very profound for our investments, our freedom, our liberties, and our lives in general. But I do believe there are, some bright spots, and we'll be talking about that most certainly. This is the kind of environment that gold and gold investments can be expected to do very well. It's not the reason I want to see my gold investments go up, but it is what it is, and we want to try to do the best we can to protect for our families as we go through this year. So let me just say, if there's one event in my life, and I'm 73 years of age, so I have a lot to look at in the rearview mirror, it was August 15th, 1971. If you want to look at the conditions that we have today, I think you have to go back to that point in time. August 15, 1971, when Richard Nixon detached gold from the monetary system globally, at least in the free world. And what that did was really provide the unlimited ability for the world reserve currency, at least for the United States as a dominant power, to create unlimited amounts of money. And so we have, and it is leading to some of the major problems of income disparity and indebtedness that has really taken us to the verge of a monetary collapse globally. So in 1971, this is what happened as a result of it. You see the peak going back into World War II. This is total credit debt. This isn't just U.S. debt. This is total debt to GDP. So we far surpassed, as the 2008 financial crisis approached, we far surpassed the total amount of debt to national income. And that was before 2008. The slide that you see there is up until the first quarter of 2008. Of course, it rose dramatically after that before leveling off with quantitative tightening after the Fed tried to go back to normalize its balance sheet. But the fact is that the debt has remained, and now it's surging again much, much higher as a result of the quantitative easing that is following the COVID virus and now other chaos that is taking place in America. This is a slide that just simply shows the U.S. federal debt. This is the government's federal debt relative to GDP from about 35% or so in 1971 when Nixon took gold away from money and projected to be through 2021 nearly approaching 140%. This is an amazing a level of debt to GDP, and of course this doesn't account for the massive decline that we may be seeing now in GDP, and we most certainly are seeing. Consumer inflation. This is the courtesy of Shadow Stats, John Williams, who's a frequent guest on my radio show. An independent economist goes back to continued to measure inflation as it was measured before the Reagan era. And essentially in the old days, it was a measurement of what it cost to keep a family of four alive. But during the Reagan years, they started tweaking and playing around with the way they calculated inflation. They started using substitution. If you don't If you don't like steak, you can have hamburger. They started using hedonic pricing, and really has taken us far away from what the actual cost of staying alive is. And this is a complicated discussion beyond the time I have today, but it's something that John Williams talks about frequently. But it's very important because it makes all the difference in the world in terms of what average people are experiencing compared to the people that are on the top of the income scale. I have a lot of confidence in John Williams' work and in his inflation numbers, and this chart illustrates why. The blue line is John Williams' inflation level. The red line is the government's inflation level. And you can see from 1971 and then 1980 or so, the departure when they started accounting for inflation differently. Now, to me, the fact that the yellow line, gold, it fits very well over time with inflation, tends to confirm, in my mind, that John Williams' inflation work is much more accurate than what the government is giving us. So GDP, then, if you were to take GDP and decrease it by John Williams' inflation numbers, John is convinced that we've seen a contraction or a recession continuously, pretty much since the beginning of the new century. Briefly, and maybe in 2004, we saw some positive numbers according to John's inflation numbers. But this, I think, is very important to consider that many Americans have been seeing their living standards decline dramatically since that period of time. There's the reason, I think. When Nixon took us off the gold standard in 1971, he paved the way for exporting massive jobs overseas. That's because the United States could now start to create money out of nothing. Consumers could start to spend. And what we did was then, with the United States being able to create money and credit as we did, it allowed governments, it allowed corporations to send their jobs or high-priced jobs overseas. So this is really, we saw the manufacturing base of America decimated since that point in time. The U.S. merchandise trade balance is shown there, and it's been in chronic deficit ever since 1971, except for perhaps 1 year in the early time frame right after 1971. So this has really hollowed out the middle class. It has destroyed the average people that people that might have earned $50,000 or $60,000 now working at Walmart or flipping burgers for $20,000 or less a year, something like that. That's sort of traditional and typical of what we've seen. This chart, I think, really shows what happened to the middle class in 1971. Wage earners, 90% of the bottom, 90% of the wage earners were doing very well until 1971. And the top, not so well, but until after 1971, the redistribution of income, because when money can be created out of nothing, it's doled out to people who are closest to the feeding trough. The government, the military-industrial complex, corporate jobs, people that have good connections in Washington had laws passed in their favor. And so all of a sudden, the middle class that lost their manufacturing jobs overseas are being decimated. And then if you add John Williams' inflation numbers, really hit harder than is generally recognized. But the top 1% has done extremely well, and those are the people that you're hearing most from on the media. Unemployment rates also, John continues to count unemployment as we did during the Great Depression. Since then, our government has come back with the official number. That's the one we hear all the time. The inflation, the unemployment numbers around 15%. That's what they're telling us now after this latest COVID problem. And then the U6 numbers, which allow, go out a little further and say the people that are still in the labor market but are not employed. And then at some point, the United States government just stops counting people after a certain period of time. Well, John Williams continues to count them just as they did in the 1930s. And he's looking now at a post-COVID problem here of about 35%. Again, 1/10 of the top 1/10 of people own as many assets as the bottom 90%. It's just astounding what's happened in terms of the decimation of the middle class and the lower income people in America since we went off the gold standard in 1971. I show this chart primarily. This shows delinquencies over 90 days. And since 2008, a lot of the debt has been, a lot of personal debt has been decreased, but student loans, of course, have gone up dramatically during this time frame. And I point that out only because I think that much of the unrest among the looters and the people that have really raised a lot of hell in recent times is from the younger people who I think are looking at job prospects as not being very bright, and then being indebted with huge amounts of college debt, which is really a huge problem for them. Now, this really, I think, is a slide that suggests why there's so much unrest. I've been talking about the middle class being decimated since 1971. But if you look at the super wealthy, this is just incredible. You know, back in the 1980s, when the lower income groups were doing very well, sure, they had the biggest percentage of income, so they were losing, and the growth rate declined over time. But now we're seeing that that's reversed, and that the higher the income, the higher the growth rate now. So this is another thing that, and every time the Fed creates more money, every time it bails out whenever it bails people out, it redistributes wealth to the people that are closest to the feeding trough, to the people in the financial markets, to people in government that have great jobs. And this is what we're getting. This is what I think we're starting to see now. And I don't think that anybody should take this lightly, because this is a very serious threat, I believe, to the United States government right now, what is occurring from the left side of the political spectrum. And we have Seattle. You've all seen the pictures. Los Angeles. Almost every major city has had these kind of ruthless lawlessness that is just really very, very problematic. The federal debt, since President Trump came in, it's increased by $4.2 trillion. This is projecting the federal debt to 2024. The CBO and the OMB are generally not very conservative. They generally look at as if we're not going to have any recessions. They assume a certain growth levels that are generally proved to be unrealistic. The USDC, that is basically on what is happening now. And so we're looking at a $47 trillion deficit, or debt, I should say, by 2024, according to that. Now, let's hope and pray that that isn't true. But that's the way it's looking now if things don't get as rosy as CBO and OMB suggest. I talked in my last Metals Investor Forum back in a month ago about the canary in the coal mine, and this was the repo crisis in which the repo market rate spiked up to 10%. What's been going on here for some time, first of all, Trump was spending money just like a drunken sailor, like every president tends to, with no restrictions on the amount of money we can print. Every president has tended to print more and more, but Trump was going to show that he was bigger and better and a bigger spender than everybody else. Like he's, for almost every issue that you talk about, Trump is the greatest. So he was going to spend more money. So he's running, before COVID, a $1 trillion deficit annually. Keep in mind this slide is before COVID. This was in September 2019. And what we've seen is a decline in foreigners' appetites. The net export nations are not buying treasuries anymore. The big banks have been doing what they're supposed to do. They are the market makers for the treasuries, and they were buying as many treasuries as they could until they bumped up against the post-crisis regulation that requires big banks to keep a certain amount of credit on hand. And so all of a sudden there was nobody to buy treasuries. And the Fed then had to give up on its quantitative tightening and started quantitative easing by pumping huge amounts of money into the system. And that has not let up since September. As a matter of fact, it looks like it's getting worse. It's not surprising because the government is spending huge amounts of money. Where is it going to come from? Where is the money going to come from to pay for the debts? The trillions upon trillions that are being pumped into the system now. Well, we're seeing the Fed has to pump in more money, and it has in June, the first week in June, almost $300 billion. This slide just simply shows the decline in appetite for buying treasuries. Now, keep in mind, this is foreign international investors as a percent of gross domestic product, and the gross domestic product, of course, during the years right after the financial crisis declined, so that ratio was made worse. But the appetite from foreigners to buy U.S. treasuries is declining very dramatically. That is in terms of new treasury offerings and so forth. So John Williams, again, he has, some of you may remember when the Fed said it was too expensive to calculate M3. Well, John Williams sort of made a joke. I mean, it really is just shown how ludicrous that is, because he continues to calculate M3. It's not hard to do, and he would explain it to his subscribers at shadowstats.com. But here we see the M3 in sync with the government's numbers, M2 are the Federal Reserve's numbers, M2 and M1, and a 30% increase right now annually. Since this year, more than 100% of new Treasury issuances has been monetized. In other words, the Fed created money out of thin air to buy these Treasuries. I think the United States, you could make the statement that we are broke, and it would be an accurate statement. And one person who gains a lot of support from the mainstream is Stephen Roach. Now he is a professor now at Yale, long time Morgan Stanley, used to read his missives all the time. He has long been worried about the United States living beyond its means, relying on the kindness of strangers to pay for our excessive living standards. And now he is quite convinced that we are on the precipice of a decline in the dollar. He's talking about 35%, which might not be the end of the world in terms of the index. But there is a considerable concern about the United States for sure. And as nations see our country burning and the chaos that's created, it doesn't inspire confidence of other nations to buy our treasuries, that's for sure. I just show this slide frequently to remind us that reserve currency status doesn't last forever. We're pretty much as long now as Spain, well, I say as the Netherlands and Portugal. These things do come to an end. Gold during the Weimar hyperinflation, well, there was a great deal of volatility, and as James Rickards recently noted, he said that that a lot of the Germans didn't buy gold in those days because they saw the stock market going up so dramatically. Why buy gold if you can just keep the money in the stock market? Well, the problem was they woke up one day and realized that the stocks were denominated in marks and they were worthless. And so the question is, if the dollar becomes worthless, Jay, what's the sense in owning gold shares that are denominated in dollars? Well, I think the reason you do is because underlying those gold shares, assuming the government still allows us to own stocks, assuming the government still allows us to own private property, then if we own gold shares, the gold shares represent ounces of gold in the ground. Of course, the question will be, can they get it out profitably? And that's something we have to look at individually with each company, know their projects, and know what their cost of getting the gold out. Because if we're in a hyperinflationary environment, then it may be very problematic for a great deal, especially of the lower grade projects that are producing gold. Now, maybe I'm just the traditional old gold bug crank that thinks things are going to hell in a handbasket, but maybe things aren't as bad as I'm suggesting they may be. Maybe things are not all that bad. But if we just go back to the start of this century, the green line represents the S&P if it were denominated in real money, in honest money, in gold. It hasn't gained. In fact, it's declined. The blue line shows you where the S&P has gone, denominated in dollars. But now compare that with the red line, which is the price of gold since the beginning of the century. Gold has beaten everything hands down. It's beaten Warren Buffett's investments hands down. So if nothing else, gold has done extremely well for investors so far in certainly in this environment so far, before we even started having these enormous problems that we're facing now. So the main thing that I would like to mention is that we're looking now at, I think, a very, very strong bull market for the gold mining sector. These are average earnings projections by the analysts that cover these companies. This is a small cap. I show the small caps here because they're closest to the companies that I follow. Most of the companies I follow are not producing yet. They're exploration companies. But you can look at the growth, looking at something on the order of 675% since 2018, projected through 2021 in earnings for the small caps. The mid caps, 246% projected growth, and the big guys, 167%. So that's pretty much it. I think the idea is that this is a great time to own gold shares. If there's a silver lining, or let's say a gold lining in the clouds and a silver lining, it is that this is a great time for precious metals. And I say that with sort of a heavy heart, because what's going on in my country is very disturbing to me. I think it's very alarming. I think the basic rights that we've enjoyed, including property rights, could be under attack. But we have to go with what we have. And what I think we have is a bull market in gold and gold mining shares